Navigating the labyrinth of money management in algorithmic trading.
Algorithmic trading is a form of trading that uses computer programs to execute orders based on predefined rules and strategies. It can offer many advantages, such as speed, accuracy, consistency, and reduced human error. However, it also comes with its own challenges, such as technical glitches, market volatility, and regulatory issues. One of the most important aspects of algorithmic trading is money management, which is the process of controlling the risk and reward of your trading activities. Money management can make or break your algorithmic trading performance, as it determines how much you can afford to lose and how much you can expect to gain. In this video, I will discuss 3 key points that can help you navigate the labyrinth of money management in algorithmic trading. Point 1. Establish a baseline, know your risk tolerance, and adjust your position size accordingly. The first step in money management is to establish a baseline, which is the amount of money you are willing to risk per trade. This depends on your personal risk tolerance, which is the level of uncertainty and potential loss you can handle. Your risk tolerance can vary depending on your trading goals, experience, and psychology. Some traders are more conservative and prefer to risk less, while others are more aggressive and willing to risk more. There is no right or wrong answer, as long as you are comfortable with your risk level and can stick to it. Once you have determined your risk tolerance, you can use it to adjust your position size, which is the number of units or contracts you buy or sell in a trade. A common rule of thumb is to risk no more than 1% to 2% of your total capital per trade. For example, if you have $10,000 in your trading account and you want to risk 1% per trade, your maximum loss per trade should be $100. To calculate your position size, you can use the following formula. Position size equals $100 per 20 pips. $10 equals 50 units where risk per trade is the amount of money you are willing to lose per trade. Stop loss is the price level where you exit the trade if it goes against you. Pip value is the value of 1 pip, the smallest price movement, in your trading currency. For example, if you are trading EUR/USD and you want to risk $100 per trade with a stop loss of 20 pips, your position size would be position size equals $100 per 20 pips. $10 equals 50 units. This means you can buy or sell 50 units of EUR/USD and risk $100 per trade. By adjusting your position size according to your risk tolerance, you can control your exposure and avoid risking too much or too little. Point 2. Increase cautiously as your capital grows, so should your position size. The second step in money management is to increase your position size cautiously as your capital grows. This means that you should increase your risk per trade proportionally to your account balance. For example, if you start with $10,000 and you risk 1% per trade, your risk per trade would be $100. If your account grows to $15,000, your risk per trade should increase to $150. This way, you can take advantage of the compounding effect and grow your capital faster. However, you should not increase your position size too quickly or too much, as this can expose you to higher risk and volatility. A sudden increase in position size can also affect your trading psychology and make you more emotional and less rational. Therefore, you should increase your position size gradually and consistently, and never risk more than you can afford to lose. Point 3. Balance is everything. Allocate capital wisely between risk and return. The third step in money management is to balance your capital allocation between risk and return. This means that you should diversify your portfolio and trade different markets, instruments, and strategies. By doing so, you can reduce your overall risk and increase your potential return. For example, if you trade only one market, such as stocks, you are exposed to the risk of that market. If the stock market crashes, your portfolio will suffer. However, if you trade multiple markets, such as stocks, bonds, commodities, and currencies, you can hedge your risk and benefit from different market conditions. Similarly, if you trade only one instrument, such as EUR/USD, you are exposed to the risk of that instrument. If EUR/USD drops, your portfolio will suffer. However, if you trade multiple instruments, such as EUR/USD, GBP, USD, USD, JPY, and AUD/USD, you can diversify your risk and take advantage of different price movements. Likewise, if you trade only one strategy, such as trend following, you are exposed to the risk of that strategy. If the market is choppy and sideways, your strategy will fail. However, if you trade multiple strategies, such as trend following, mean reversion, breakout, and scalping, you can adapt to different market phases and capture different opportunities. By balancing your capital allocation between risk and return, you can optimize your performance and achieve your trading goals. However, you should not over-diversify or over-complicate your portfolio, as this can dilute your edge and increase your costs. Therefore, you should find the optimal balance that suits your trading style and objectives. Conclusion: money management is a vital skill for algorithmic traders, as it can determine the success or failure of your trading endeavors. By following these 3 points, you can navigate the labyrinth of money management in algorithmic trading and improve your results. Remember, money management is not a one-time event, but a continuous process that requires constant monitoring and adjustment. As your trading evolves, so should your money management.
Happy trading!